So welcome everyone. My name is Anne Groenen and it is my pleasure to welcome you to this webinar on the Belgian Scheme for Job Retention Support, better known as temporary unemployment. The temporary unemployment system was probably the best known pillar of economic crisis policy during the COVID-19 pandemic. At the height of the crisis, almost 1 in 3 jobs was supported by temporary unemployment. But even outside the COVID crisis, temporary unemployment is often used to protect our labor market from shocks, from crises, and to act as an automatic stabilizer. To contribute to the ongoing debate on the optimal design of such job retention schemes, the Ministry for Employment has asked the OECD to conduct an evaluation of the use of temporary unemployment during the COVID-19 crisis, but also its aftermath, and compare it with other OECD countries. This study is now being launched today, and our first speaker, Dr. Jonas Vluchtman from the OECD, will present the results. Dr. Vluchtman is a labor economist specializing in social policy and labor market analysis within the Jobs and Income Division of the OECD Directorate for Employment, Labor and Social Affairs. Of course, our own National Employment Office, the RVA or ONEM, also constantly conducts research and monitors the wealth of administrative data on all types of unemployment benefits and employment measures for which they are responsible. So we have invited Michiel Seegaert, the head of the Studies Department at the National Employment Office, to respond to these findings and present their own study on temporary unemployment for economic reasons that was published just over a week now. Afterwards, there will be time for your questions, and then we will end with Tom Bevers, Advisor General for International Relations and Socio-Economic Studies at the Ministry for Employment. So I will start by giving the floor to Dr. Jonas Vluchtman. Jonas, thank you very much for being here today and presenting the work that you have done.
Thank you very much, Anne. Let me just share the slides I have prepared. And you let me know if you can see them. It's coming up. Can you see the slides?
Yes, but they're not yet. Now they're full screen.
Yes, perfect. Great. Yeah, thank you very much, Anne, for the introduction. And yes, I'm going to present our new report that we launched today on an assessment of job retention support during the COVID crisis and its aftermath in Belgium. And this is coming as a second evaluation of a job retention scheme during the COVID crisis after a recent report that we published on the Spanish job retention scheme as well. And for this work, we are, of course, very grateful here for the support by the Ministry of Employment that financed this report on Belgium. In this report, we, of course, look at job retention schemes, particularly the Belgian temporary unemployment scheme, and how it fared during the COVID-19 pandemic, as well as how it compares to the schemes of other OECD countries. The background to this is, of course, that job retention schemes are a crucial tool to avoid job losses during economic downturns, such as the COVID-19 pandemic clearly was, where it also saved an estimated 21 million jobs across OECD countries. And to respond to the pandemic, Belgium leveraged its already established temporary unemployment system, which consists of a wide array of special sub-schemes, for example, a scheme for economic reasons that is also differentiated by blue and white-collar worker schemes. There's schemes for bad weather, for strikes, and so on. So there's a wide array of different schemes that apply in different circumstances. And for the pandemic, Belgium created a more simplified and more generous force majeure scheme that was specifically tailored to the needs of the pandemic, and which, of course, rapidly scaled up once we saw the lockdown measures in place. If we look at the figure here on the right, where we can see Belgium in the red lines against some other OECD countries, we can see that at the peak in April 2020, the take-up was about 30% of dependent employment in Belgium. So about 30% were on temporary unemployment at this time. And this is significantly higher than the OECD average, which is about the take-up rate of roughly 20%. And it's also 6 times higher than the previous Belgian peak during the Great Financial Crisis. In this figure, we can also very well see what Anne just mentioned earlier, that there is some, or that Belgium stands out somewhat in terms of persistence of the job retention scheme use. Compared to, for example, France and Germany that we also see in this figure here, the use of job retention support was already high before the great financial crisis. It remained so afterwards as well. In fact, if we look closely at the figure, we can see that there was barely any difference in use during the great financial crisis, and the scheme then also remained relatively persistent just until the onset of the COVID-19 pandemic, where we then see this massive spike of 30% of take-up. Today, 6 years after the onset of the COVID-19 pandemic, the use of temporary unemployment is still continuously high. Of course, not as high as during the peak of the pandemic, but we still see, for example, in early 2025, we see about 3% of dependent employment still placed on temporary unemployment. And this is by far the highest rate among all OECD countries, where it's typically considerably less than 1% of employment on temporary unemployment. And this persistence of use then, of course, raises concerns of slowing economic recovery, hindering job reallocation, and worsening labor shortages, as these workers who are placed on job retention support are particularly or practically locked into their jobs and are less likely to transition to more productive firms or into areas with labor shortages. To look at all of this, in this report, we therefore provide a detailed assessment of the Belgian job retention scheme during and after the COVID-19 pandemic. We do so by providing an empirical analysis of job retention scheme take-up in Belgium across firms, across workers and sectors. And we're also going to look at how Belgium compares to other OECD countries by benchmarking it against these countries using a new synthetic indicator on the effective generosity of job retention support that we're introducing in this report. And at the end of the report, we also provide an estimation of how successful the scheme was in preserving jobs during the COVID-19 pandemic and beyond. So in the first part of this report, we're going to detail how the temporary unemployment scheme was used in practice in the Belgian labor market. That is, in which sectors it was concentrated, as well as among which workers and firms it was predominantly used. And for this, we're very grateful for access to administrative data, both from the national, from ONEM, and as well as the Crossroads Bank for Social Security, which also provided access to administrative data. As I mentioned before, Belgium was quite successful in quickly introducing the simplified force majeure scheme once pandemic-related containment measures, including the lockdowns that we all remember, were introduced. And this simplified force majeure scheme that was introduced then represented a rapid scale-up of the existing temporary unemployment scheme by streamlining the administrative procedures, as well as harmonizing the access for both blue and white-collar workers, while also raising the statutory replacement rate from 65 to 70% of gross earnings, plus some daily supplements. But of course, there were also some income. The income replacement was subject to some income caps, which we'll see in practice a bit later on when we compare the different systems across OECD countries. And this ensured that temporary unemployment was essentially available to all workers, except with some exceptions for some workers on short-term contracts. It was generally accessible through less formal administrative procedures, and also supported the purchasing power of a large number of workers that saw their workplaces halt economic activity. And here in the figure, we can see how quickly the scheme found widespread application. And here we can see the force majeure temporary unemployment payment as a share of dependent employment here in turquoise. And as you can see, this rapidly increased as lockdown measures were implemented in March 2020. So we have this very strong increase from less than, let's say, 4% to almost 20% already in March 2020. And this virtually replaced payments made through other schemes, such as the one for economic reasons and the one for bad weather, which we see in dark and light blue here in this figure, and which would have been the dominant schemes in a normal year, such as 2019 was. And while this figure shows very well how the simplified force majeure scheme was effective by scaling up rapidly at the onset of the lockdown measures, we can also see that the simplified variant remained active for a particularly long time, only phasing out in June 2022, where we see the last of these turquoise bars, which was, of course, well after the immediate effects and most severe containment measures already subsided considerably. Now, if we look at in which sectors and among which workers the scheme was concentrated, we can see a few interesting findings emerge. On the left, we can, for example, see that the scheme was concentrated among sectors particularly affected by the pandemic, but also those sectors that are characterized by more persistent use in the past. For example, the use during the pandemic was particularly high among traditional users, such as the construction and manufacturing sectors, but also in other sectors that were newly but also strongly affected by lockdown measures, such as the hospitality and food services sector. And importantly, the hospitality and food services sector previously barely used temporary unemployment at all, but was still able to rapidly scale up at the onset of the pandemic. And this suggests that the simplified procedures of the force majeure scheme during the pandemic worked quite well in practice and made it easily accessible even for those firms without extensive prior knowledge of the use of the scheme. In terms of workers, we can look at the right here. We can see the workers that were placed on temporary unemployment, broken down by white and blue collar workers. And due to the scaling up of the scheme, the nature of the pandemic, and the loosening of the eligibility criteria, we can see that white collar workers accounted for about 43% of recipients at the peak of the pandemic, which is considerably more than the less than 10% before the pandemic. So the nature of the pandemic and also the easing of eligibility criteria really also made white collar workers use the scheme considerably more than in previous years. If we then look at the types of firms which used the scheme, we can see that it was naturally skewed towards those that may have been more exposed to liquidity constraints during the pandemic. For example, as we can see in the dark blue bars on the left here, the use of job retention schemes during the pandemic was considerably higher among workers in firms with lower productivity levels, and much more so than prior to the pandemic. At the same time, workers in firms that have previously used job retention schemes were also much more likely to use these schemes during the pandemic. And this is something we see on the right, where we have broken down the use during the pandemic by whether these firms previously used or previously didn't use job retention schemes. And taken together, these patterns suggest that the use and persistence of these schemes were driven by a combination of acute necessity and potential pre-existing structural dependence. For sectors hit by a severe shock, such as the accommodation and food services sector, the sheer necessity of survival drove widespread job application adoption, job retention scheme adoption, of course. However, in most other sectors, previous experience was a key determinant, so that firms that had used the job retention schemes before the pandemic were also significantly more likely to use them again, and also more intensively so. And the most crucial difference here lies in persistent use, as for firms without prior experience of job retention schemes, these were largely temporary tools that was eventually abandoned as the crisis faded. In contrast, for firms with pre-pandemic experience, the scheme acted perhaps as a readily available and already embedded operational tool, with the usage remaining elevated even long after the strong main effects of the pandemic and containment measures subsided. Now we can also look at how the labor market and the dynamism of the labor market worked before and during the pandemic. Before the pandemic, we can see that Belgium's labor market consistently reallocated workers from lower to higher productivity firms. And this is represented in this figure, where a larger positive value basically represents a stronger employment growth responsiveness to productivity levels. That essentially means that the strength of productivity enhancing labor market relocation from less to more productive firms was stronger. And as you can see, before the pandemic, this happened mostly through job-to-job mobility, which are transitions from one employer to another one without an intermediate unemployment spell or non-employment spell, which we can see here in the dark blue bars. And it happened also to a lesser extent through employment mobility in the light blue bars of the light blue part of the bars here, which are transitions in and out of employment. And while job-to-job mobility continued to operate similarly during the pandemic, at least in net terms, we can see that it was significantly dampened by employment mobility, especially in 2021 and 2022, where it began contributing negatively to productivity-enhancing reallocation. We see, for example, that less productive firms, which were the primary users, as I mentioned before, saw reduced separations rather than increased hiring, which kept workers attached to these jobs in lower productivity firms. And while reducing these employment losses during the crisis was, of course, intended, the negative contribution from employment mobility persisted well beyond the acute phase, continuing into 2022, as we can see here. And while job retention schemes then likely preserved employment during the crisis, its effects on labor market dynamism lasted much longer, as job retention scheme take-up in Belgium was persistent well after the pandemic, as we've seen earlier, and therefore likely disrupted the normal functioning of the labor market. Now, we might think that there were simply no jobs available, and therefore driving depressed labor market dynamism and productivity-enhancing relocation. However, as we can see here in the figure, all of this happened despite a considerable increase in vacancy postings from early 2021 onwards, exactly when we saw the most negative effects or the negative developments in labor market dynamism. And this happened especially in sectors that used job retention schemes the most, for example, construction, manufacturing, as well as food and accommodation services, to some extent also in administrative and support services. And this suggests that productivity-enhancing job relocation remained suppressed well after the COVID-19 pandemic, which then most likely had dampening effects on overall productivity growth and labor shortages, as we also saw the increase in vacancy postings. Now, in the second part of the report, we turn to a more cross-country analysis to systematically compare the Belgian job retention scheme with those of all other EU OECD countries, as well as the United States. And this can offer valuable insights in how the Belgian scheme differs from the schemes in other countries and which aspects may have driven the persistence of job retention scheme use. And for this, we're introducing a new synthetic indicator of the effective generosity of job retention scheme support in this report, which helps us understand how job retention schemes compare across the OECD and how they developed throughout the COVID-19 pandemic and its aftermath. And for this, we define effective generosity, we have that here on the right of the slide, as the product of workforce eligibility, which is the share of employees who can access support, the work sharing potential, which is the maximum permissible reduction in working hours, as well as the generosity of the schemes, which is measured as the cost to governments in supporting non-work hours at average wage levels. So this effective generosity basically gives us a very nice synthetic indicator for which you can compare support for workers at average wage levels. How that developed in Belgium and the OECD overall is something we can see on the left here, where we have Belgium in turquoise against the OECD averages in blue, dark blue for the overall OECD average, light blue for permanent schemes in the OECD, alongside the red line, which shows us how intense the lockdown measures were over time in Belgium. And we can see, as I mentioned before, that it rapidly scaled up support at the onset of the crisis. For example, between March and May 2020, the effective generosity doubled from roughly 30 to 60% of labor costs. However, if we look at the turquoise bars against the blue ones here, we can see that as the pandemic and containment measures considerably subsided, especially from mid-2021 onwards, other countries gradually tapered their support as economic activity resumed, and Belgium maintained the elevated level of generosity at least until the end of 2022, which we have shown you. And as a result, Belgium's support persisted long after many temporary unemployment schemes, such as the temporary job retention support schemes, such as the ones in the UK, the Netherlands, and Estonia, already had ceased, and other countries have reduced the effective generosity of job retention support. And this kept the effective generosity level high, even as the OECD average returned to roughly near to pre-pandemic levels. And this sustained generosity likely contributed to the elevated take-up observed well beyond the end of the pandemic. We can see this here as well, where we compare the same indicator across countries for specific periods of time. And we can see that Belgium, together with Luxembourg and perhaps also Finland, stand out as having had very minor adjustments in the generosity from May 2020 as compared to December 2022. As we can see here, if we compare the arrows in May 2020 with the white circles in December 2022, in Belgium there was a very minimal adjustment, the same in Luxembourg, but for most other countries we saw considerable downward adjustments or phasing out of temporary schemes. Next, we can break down the effective generosity indicator and look at all these subcomponents that make up this indicator, which can show us really where this effective generosity comes from. Here we consider the eligibility component, which is measured in terms of potential take-up as a share of private sector dependent employment. And we can, of course, look at two aspects of this, which is firm and worker eligibility. When we look at firm eligibility, we generally see very few barriers. Most OECD countries removed size or sector restrictions during the COVID-19 pandemic to support the private sector more broadly. Some countries also provided additional support. For example, in the US, the Paycheck Protection Program was a more generous program that was restricted to small and medium-sized employers. The most significant change in eligibility happened for workers, as some schemes, for example, the German Kurzarbeit scheme focused on permanent insured staff, while others shifted from a classic automatic stabilizer to a broader goal of protecting public health during the COVID-19 pandemic. As a result, most countries, as we can see here, considerably expanded coverage also to temporary and uninsured workers, reaching eligibility of pretty much 100% in the majority of OECD countries. Belgium was no exception here, as its force majeure scheme bypassed the insurance requirements of the standard scheme and was available to both blue and white collar workers. However, there are some on short-term contracts that didn't qualify for this support, nor that they qualify for some unemployment benefits, leaving them potentially quite vulnerable during the pandemic. Next, we're coming to the restrictions on working hour, the permitted hour of reductions in working hours, and generally restrictions here on how much working time can be reduced are rare. But if they are in place, they can of course curb the use of job retention schemes quite strongly. For example, while most countries allowed for a full suspension of work during the pandemic, the US kept a strict 60% limit on working hour reductions for its short-time compensation program. Other countries like Germany and France managed this differently. They focused on participation, requiring minimum shares of workers or entire units to join the scheme. Belgium didn't impose any work sharing requirements, therefore offering quite some flexibility. But of course, and we're going to come to that very soon, there were some incentives for work sharing through the responsibility contribution. When we look at the generosity to workers, we see that replacement rates for the average worker on the left, for workers on average wages, rose from 30 to 70% during the pandemic. For some countries, this was much larger. For example, if we look at the US, it goes to as much as 120%, but this is due to a temporary $600 weekly lump sum payment regardless of the hours worked. Belgium is clearly an outlier here for workers at average wages, largely due to the strict benefit caps that I mentioned earlier. If we account for these, the government covered only about 45% of income at average wages. And this places Belgium in the lower quartile of OECD countries at the peak of the crisis. However, if we look at this figure, we can also see that this replacement rate barely changed also as the pandemic subsided, or as compared to prior to the pandemic. So it was relatively stable, the generosity to workers. If we look at lower wage workers, those on 67% of the average wage on the right, here they were somewhat better protected as they retained about 74% of their income, which is very close to the OECD average for workers at these wage levels. This means that essentially the Belgian model is highly protective of the vulnerable, but offers much weaker income stability for the average worker compared to other peer countries. And this suggests that distinguishing potentially between blue and white collar workers, as currently in the Belgian scheme, might no longer be necessary, as the system's current design already effectively protects the most vulnerable workers through the replacement rates and the stricter benefit caps for workers at higher wages. Then the last part are, of course, the cost to firms, which are the primary lever for controlling the use of job retention schemes. We did find that after containment stringency, this cost to firms was the single most important driver of take-up across the OECD during the pandemic. Of course, low costs during acute crisis are able to save jobs, as firms can easily access job retention support, but higher costs can prevent the support of unviable jobs, especially during a recovery. Exactly. So at the onset of the pandemic, we see that most countries reduced this cost to firms to zero, effectively preserving jobs when the shock was most severe. However, as most economies reopened, most OECD countries reintroduced some sort of co-financing by requiring firms to cover a share of the cost of job retention scheme support to ensure that the support targeted only viable jobs that were viable in the long term. Belgium is some kind of outlier here, as explicit, or an outlier among a few other countries, as explicit co-financing requirements for firms are largely absent. For white-collar workers, for example, if there exists, any firm contributions are determined by collective bargaining, or for blue-collar workers, we have the responsibility contribution, where firms only face a penalty after 110 days of persistent use among a certain worker. And this is a cost that can easily be reduced by spreading support across the workforce. I'm going to talk about that a bit more on the next slide. And because these costs for firms remain so low for so long, Belgian employers have little financial incentive to exit this scheme, which might directly explain the high persistent rates of job retention scheme take-up in Belgium we observed earlier. Now we have this responsibility contribution in Belgium, which is supposed to prevent permanent reliance on the scheme for blue-collar workers, which is essentially a penalty that kicks in once a worker has been placed on temporary unemployment for 110 days. And the cost of this escalate quite aggressively, from 20 euros per day initially to 100 euros per day if the usage exceeds 200 days. However, the scheme is designed in a way with a specific incentive for work sharing. If we look at this, we can clearly see this. If a firm keeps one worker on the scheme for 240 days, which we see on the leftmost bar here, they owe quite a lot of money, 8,800 euros roughly. But if they split the same 240 days between two workers, this penalty drops to just 400 euros due to this incentive for work sharing. And this structure then strongly incentivizes firms to rotate workers on and off the scheme rather than leaving specific individuals inactive for long periods, which is in itself, it's of course a good approach, but it doesn't necessarily suffice to curb structural use of job retention scheme support. Now, in the last part of the report, we also provide an analysis of the employment effects of job retention schemes during the pandemic. And we look at this by considering how changes in containment stringency affected employment growth at the country occupation level throughout the pandemic. And to isolate the effects of job retention schemes, we exploit differences in the generosity across countries and time, based on the effective generosity indicator that we just developed in the previous section, alongside differences in the need for support, job retention scheme support across occupations. And we proxy that by the potential to telework. And then we essentially have a triple difference in difference approach and can look at this in a local projection model, which allows us to identify the effects, if effects were stronger for more exposed occupations, those that were unable to telework. And if we look at the left here, where we plot the employment growth across occupations, split it by non-teleworkable and telework occupations, and look at what would have happened in the absence of average of job retention scheme take-up, and what would have happened for these occupations with average levels of job retention scheme take-up, we can see that job retention schemes were indeed effective in preserving employment, but only in non-tailor workable occupations, which is this distinction that we can very well see in the gap between the blue and red bars on the left. So the difference for non-tailor workable occupations if they used job retention schemes or didn't use job retention schemes. And this aligns very well with the scheme's intent, as tailor workable occupations were, of course, far less exposed to containment measures and could largely continue operate during the pandemic from home. And as such, if we take that to the aggregate on the right here, we can see that the job retention schemes averted average employment losses of 8% across countries at the peak of the pandemic, and reaching as much as 12.9% in Belgium. So it was pretty effective in Belgium in preserving employment losses. However, we can see it a little bit at the end, even though it's not very strong, as the effects of jobs saved turn a bit negative towards the end of the crisis, as take-up was persistently high even after the pandemic had subsided. So overall, all of these findings suggest that the Belgian temporary unemployment scheme was highly successful during the pandemic. It was a very good scheme that was able to scale up rapidly, reach a large amount of workers, and support workers, especially in most vulnerable sectors. However, we also see that it's particularly persistent, and the structural use remains elevated even today. Therefore, there are some aspects of the system that might benefit from adjustments in order to make the scheme even more effective and fit for purpose in the future. To improve the scheme, the generosity of job retention support could be adjusted earlier in the recovery phase, rather than keeping it static for a long time. For example, we can look at other countries here like Spain, for which, as I mentioned before, we also had a very interesting recent report on the job retention scheme, in which progressively increased the cost for firms as economic restrictions were withdrawn, which helped scale down the support as the immediate crisis subsided. One way to do this would be to introduce experience-rated employer contributions, which could also help to curb structural use of the scheme. And this effectively, these experience-rated employer contributions effectively mean that firms using the scheme more frequently are required to contribute more to its financing, basically similar to an insurance premium that rises with claims. France recently introduced something like this through a bonus-malus system in their unemployment insurance, which modulates social security contributions to penalize firms that rely too heavily on short-term churning of staff. Furthermore, even though this might be somewhat complicated, a coordinated approach to training incentives could ensure that downtime is used for upskilling, which is currently not happening systematically in Belgium. For example, I have good examples in Germany, France, and Austria that successfully integrated this into their schemes during the pandemic, often covering the full cost of training for workers on reduced hours to prevent skill depreciation while workers are not working. And finally, the scheme could be consolidated by eliminating the distinction between blue and white collar workers. So you've already seen before, the current benefit cap already ensures that low wage earners are highly protected, regardless of their contract type. Maintaining this administrative divide is not necessarily necessary anymore to safeguard the most vulnerable workers. So that's it from me. You can find the report online. If you have any questions, you can of course also we can discuss afterwards in the Q&A, or you can write me an email. You can find more of our work also on these links here. Thank you.
Thank you so much, Jonas, for these valuable insights, for the great cooperation that we have. And as said, there will be time for questions at the end. But now I would first like to invite Michiel Seegaert from the RVA ONEM, the National Employment Office, to present their own work and in particular a very recent study that they have done. Michiel, the floor is yours.
Thank you, Anne, and good morning, everyone. I hope everyone can see my slides appearing on screen. So, as explained, I'll be talking to you about a report that was published quite recently, so just 10 days ago at ONEM, at the National Employment Office. I've abbreviated it as NEO in the slides. So this is something that was done a bit in parallel to the report being presented by OECD just now. It's not really a reaction to it, but it fits well with the narrative as a kind of a, let's say, a nuance to some of the issues that are being raised in this report, or at least I do hope so. Okay, so as the OECD report explained, during the pandemic, temporary unemployment really acted as a efficient shock absorber. Of course, this wasn't the first crisis during which the scheme was used. What you're seeing appearing on screen is about 100 years, even more, of temporary unemployment data, a temporary unemployment series. And as was explained during the last presentation as well, not only are we seeing peaks during crises, but we're also seeing relatively high levels even outside of crisis times. So one of the questions that is being raised in this domain is when does this risk becoming a structural feature of labor market adjustment? So as a partial response, let's say, to this, we have our new ONEM publication, Dynamics of the Use of Economical Partial Unemployment for of Employers. So where the OECD report has kind of a macro aggregate level data regards to this the scheme, the partial or temporary unemployment scheme in general, and focuses mainly on the crisis context of the pandemic. As explained, it has the recurring theme of job preservation versus reallocation issues. In this report, we're using micro employer data for an evaluation of the normal usage, let's say, or usage during normal times. In practice, we've studied the period of 2012 to 2019. This is the main body of our study. We also take a quick look at outcomes in 2025, but that's another part. The focus on 2012-2019 allows us to investigate a period during which we had the cascading effects of the global financial crisis. It was the time of the Euro crisis, among other things. But this evolved towards a really normal situation, even a historical depth of temporary unemployment usage. So this is an interesting period to study in terms of this usage during normal periods. And we focused on, well, we tried to establish a baseline of things we could notice in employer trajectory analysis, but we focused on two central research questions. One was to which extent does this scheme allow to serve as a buffer against firm exit and bankruptcy? And on the other hand, we really looked into this type of long-term or repeated use of the scheme and to which extent this signals inefficiencies or risks of labor market rigidity. This can serve as kind of a nuance to some of the the issues raised by OECD, which I thought would be interesting to present to you in this context. So first, why did we focus on the employer trajectories? Because aggregate take-up levels, this approach may hide some very different employer behaviors, as we will see in the next slide. Because the same instrument, the same scheme is used in very various ways by different employers depending on needs. So to capture this diversity of usage, we've tried to analyze these long trajectories of usage by employers based on how they are using the system over time. So what you're seeing appearing on the right are kind of like these is the basis of our trajectory analysis. So these are kind of like the typical timelines or the representative trajectories of different types of employers. To distinguish some different use types, we've used the following typology. We've differentiated between short-term users who have just a one-off use almost of temporary unemployment, sporadic uses for which this is recurrent but infrequent depending on whether or not there are smaller shocks to absorb during the time frame, regular uses for which we see that there is some kind of repeated and sustained use, and structural uses, which is, of course, the main focus of one of our research questions. I'd like to emphasize that this is an empirical typology, not legal or normative. Of course, legislation has a clause that structural usage which is defined by law, of course, can lead to exclusion from the system. This is not what we're meaning here by structural use. It is an empirical typology by of employers who we see during the time period are using it almost every month during the time frame that we've studied. An important aspect is that these structural users, why they are a focus group that is at risk of negative results, as explained during the last study, or as was yes touched upon during the last presentation. These are really a minority. It's about 10%, so it's still large amount of employers using this, but still a minority, so not the main rule. Aside from the frequency of usage, of course, also the intensity of usage was an important aspect that we wanted to research, because employers also differ strongly in terms of the number of workers, or let's say full-time equivalents that are involved. What we're seeing is that the average number of months, so this is the frequency, there are some differences, there are some important outliers in all four of the usage types, but especially when we're looking at the full-time equivalents, there is a massive amount of difference and massive amount of spread, which is especially visible for the structurally using employers. So this means that in general, a small number of employers account for a very disproportionate share of total volumes of temporary unemployment, economic temporary employment use. And this accounts for most of the budgetary weight. The structural uses, although in terms of employers, there's less than 10% or approximately 10%, they account during this time period for just over half of the budget used. These outliers, the main outliers, they account for more than 1/5 of budgets. So this may help explain why persistence shows up clearly at a macro level, even though it's a minority of employers that are involved. So one of the things that we are wondering is what is the use of the scheme in terms of trying to buffer, not only in terms of job retentions, which was the aspect touched upon during the last presentation, but using the employer perspective, we were also wondering, does it help employers? Does it help save firms from the risk of bankruptcy, of just retiring from being an employer? What we've seen is, in terms of outcomes for all these trajectories, that the main amount of employer users, remain an active employer after their trajectory of temporary unemployment. So this accounts for about 2/3 of trajectories that we've studied. We see that afterwards they remain an active employer. Some firms, of course, proved no longer to be viable, or at least not viable as an employer. This accounts for about 1/6. We have cross-referenced this with bankruptcy data and restructuring data to see what were the interactions with these types of firm movements during these trajectories. And what we've seen is that there were some minorities that used their time or used or have coincided during this time frame with restructuring, but in certain cases there was still closure and job loss. That was about 1/6, and only a minority combined this or combined continuing as an active employer with a period of restructuring. So this is a first nuance that we would like to bring based on our research to the aspect of possible labor market rigidity, because when we cross-reference the usage types with these possible outcomes, what we're seeing is that temporary unemployment often acts as a kind of a buffer which allows firms to adjust without immediate layoffs, of course. And we're seeing that those who remain an active employer, for the main part, almost 60% are short-time or sporadic users. Those who need to close down usually involve a majority of about 40% of short-term users. So there's a short period during which they use temporary unemployment, and afterwards they realize that they are no longer solvent, so they close their business or they scale down to the point where they no longer require any employees. When we look at those who are restructuring, so this is minority, what we're seeing is that these firms that are restructuring during this time period are often the ones who are using it as a type of regular or structural scheme. They are regular or structural users of the scheme, more precisely. So there is kind of like a correlation between the two, suggesting that even though they are structurally using this job retention scheme or this temporary unemployment scheme, they are in fact at the same time looking at how they can fundamentally change their personnel strategy in order to become more solvent for the future. So this is a nuance that we'd like to bring to the aspect of labor market rigidity, a first nuance. So our next research question was about concentration of usage. So the zoom on these structural uses that account for such high intensity of the use of the scheme. And what we're seeing is that a majority of employers who are structurally using temporary employment concern big firms, large firms with a broad activity range and often a large geographical range. So what we're seeing is that even though there is a structural use on the employer side, this does not always coincide with structural use on the employee side. So these are big firms that are encountering economical setbacks or smaller shocks in different branches of their entire structure. And so at one point they put, for instance, 2 employees on temporary unemployment from one branch. The next month they'll do the same for 2 employees on the other branch. So there's not a real overlap in the job retention aspects on the employee side, even though at an employer side, and of course these employers respond to the criteria, the eligibility criteria of being allowed to make use of economical temporary unemployment, so they are responding to an objective criteria for this. But on the employee side, there's kind of like a rotation going on, which responds to different smaller shocks that appear during in different branches. However, as I explained, there's a group of outliers, a small group of firms that accounts for really a large share of this intensive use, of the structural use, which is a cause for concern. Still, in a majority of this specific group, as we've seen, concern lower skilled or hyper specialized workers, such as those in the social economy, which often are workers with weaker re-employment prospects. So this is an important nuance as well to this observation, because this is employment with a high social value. Job loss for these firms, for these sectors, sometimes would cause a risk of higher long-term unemployment if these jobs would be lost during temporary setbacks, etc. So what we're seeing is that these large concentrations of structural usage, of possible overprotection, also coincide with more vulnerable firm profiles and worker profiles. So the structural use is often concentrated where labor market risks are higher, which is kind of like the one of the points of the scheme to protect vulnerable firms and workers. So even though this doesn't contest the risks that were explained by OECD, I think this really adds some nuance to the concerns that we need to consider. So in general, we can see that the temporary unemployment, well, the economical one that we focused on, is a very differentiated policy tool that's being used as a different kind of instrument almost by different types and typologies of users on the employer side. For the main part, it functions as an effective shock absorber. We've seen against bankruptcy, etc. And the structural usage is real, but kind of like limited and often linked to vulnerable workers, which means that we concluded that temporary unemployment combines stability and flexibility for firms with income and job protection for workers, which is consistent in general with a flexicurity logic. So you can find this study and more on temporary employment as well, usually from an employee perspective, at our studies website. All these studies are available in Dutch and French. You can find the link here, or you can follow the QR code stated. So thank you for your attention, and I think that's all for my general presentation, and we're going to the Q&A now.
Many thanks to you as well, Michiel, for this additional information. I think it adds a great level of detail to the things that we already knew. So that means indeed that there is now ample time for some questions. I will open everyone's microphone, or you can open your microphone in a second. So if you would like to ask your question, then I invite you to raise your hand, but you can also use the chat or the Q&A function to raise your questions. And I see that there already was a remark some time ago in the Q&A. So I don't know if everyone can see this, but the person that raised the remark is also raising their hand. So I will open the floor to Mr. Rosenblum. Wait. No, it's still loading, but it should be. Yes, it now should be possible to use your microphone.
Yes, and thank you therefore. At first, I wish, of course, to thank both speakers for those studies. I had already the opportunity to thank Michiel because I I am also sitting in the board of ONEM RVA, so I knew about the study as I wrote it, but it's easier to speak than to write. I was a bit surprised by the fact, and it's no criticism to be cleared, and I also can understand some of the conclusions of the OECD study, but I'm a bit surprised because the focus on the timeline is the COVID, the pandemic periods. But this one is very short in time on temporary employment. However, the conclusions are general conclusions. So I do not say the conclusions are wrong, of course, but I'm surprised to extract the very specific period and this very specific also use of temporary unemployment during that period to make general conclusions of or needs to the evolution of this regime. And I also wish indeed to remind that studies are focused on most of the time temporary unemployment economical reasons. However, during the pandemic, we used another form, another type of temporary unemployment, force majeure, which is not to be compared to economical reason. However, both are very close to each other, aware during the pandemic. Another point which wasn't clear for me in the OECD study was the point on employers' contribution. I did not maybe correctly understand your analysis, but I had the impression you totally forgot the fact the regulation foresees a minimal contribution for the employers. That's the first point. The second point is the fact that employers' contribution to temporary unemployment allocation during the pandemic were very high, and we had sometimes very unexpected results because the amounts people were having received from the employer plus the allocation, unemployment allocation, were sometimes higher than the netto salary. So this point should be, I think, a bit clearer in the study, unless I didn't understand correctly your point about this contribution. Thank you.
Thank you, Mr. Rosenblum. For now, I don't see other questions, so I'll maybe give the floor to Jonas first. And of course, Michiel, you can also share your thoughts afterwards.
Yeah, thank you very much for the thoughts. With the last point first, our understanding is that the contributions of employers were decided through collective bargaining rather than dictated by the state how much the employers would contribute to the costs of temporary unemployment. So for us, we didn't register that as a regular and all-encompassing employer contribution in our the indicators that we presented. On the first point, yeah, we looked at the COVID crisis and the aftermath. We of course also distinguished between the force majeure scheme and the normal one for economic reasons, where, as you correctly mentioned, the differences are, for example, in replacement rates and other factors are not necessarily very large. There's some they're relatively close. Of course, the eligibility criteria have been loosened during the pandemic. But for us, it was very interesting to look at the evolution throughout the pandemic and its aftermath to see at least at the macro level what might explain this persistence of use that we still see today as compared to all other OECD countries where we currently have much lower levels of temporary unemployment scheme use. So it's interesting for us to look at how does the overall evolution also not just explain how the scheme was used during the pandemic, but also how is it used today? Why is its use still high as compared to other OECD countries.
Thank you, Jonas. Michiel, do you want to add anything on this topic?
I think Jonas, as is logical, already explained some of the things I would be able to add, but this is why I think that I had the luck at both as the workload to provide some of the data for the OECD study as well. And I think that is why it is very interesting that the Belgian scheme has remained open for a longer time, while the adapted scheme for the COVID period, because precisely this allows for some insights on the general workings. Still, I think it's a valid point that if we focus too much on the COVID period, that we're only seeing a limited view. But this limited view, on the other hand, is very interesting to shed general light on the scheme because of its functioning as kind of like a stress test for the entire scheme. At my first slide, we saw the evolution since 1921. It has passed a lot of crises and it has evolved during every crisis or after every crisis, and it remains high, as I explained, during normal times. So these crisis perspectives can add some insights on the normal functioning as well, because just precisely because of the extremity of the values. But I think it's important to also study the scheme during normal times, which is why I thought that our study was a nice complementary presentation to give to bring out these two elements during the same webinar.
Thank you. There is a second question from Mr. De Wilde. Go ahead.
Yes, I think you hear me. Thank you very much. Just one more question or remark maybe on the study of the OECD, because you were telling about the aftermath, and then we saw the figures to 2022. But in 2022, and you have another measure that was the Ukraine crisis, and also after the aftermath was an energetic crisis. So it's like that, like the study only puts the focus on 2022, which indeed has a little more weight that could be possible, but it's like we don't look on what the results were of the Ukraine crisis and the energetic crisis. And yes, we have a lot of statics also at our site as a social secretary. So what we see is that, and I think the ONEM will also see that, is that only from 2024 that we see a sort of stabilization back again. So I think it would be nice from the OECD to see also the figures, not until 2022, but also to have the figures of 2024 and 2025 to have a big comparison to the other countries when we have back the stabilization of that part. Second question, it's more a technical question I have, but I think it will be very easy. In the system of temporary unemployment, we have the system that an employer always asks on before that he will put maybe people into temporary unemployment and the effective unemployment. I suppose that the figures are taken of the effective unemployment and not of the demands that they are done, because in Belgium it's not very seldom that employers do the demand for probably taking people in temporary unemployment. But in the afterwards, they don't really use it. And it's something that we see very common also with us, that people ask for to have the possibility, but not really the execution of the temporary unemployment, because it's not necessary. It's more like a sort of backup. Thank you very much.
Thank you, Mr. De Wilde. So I think it's more some some extra food for thought than large questions, but I'll give the floor to Jonas again to respond.
Yeah, thank you very much. We briefly discussed the Ukraine crisis, energy crisis amendments to the system in the report as well. Our data didn't go long enough to really study the effects of this one, so we're mostly focused on the effects of the system during the pandemic. But we discussed this in the second chapter a little bit when we talk about the evolution of the scheme and how the different aspects of the scheme have changed throughout the years. In terms of the second point, what we consider in our data is usually the payments of temporary unemployment benefits. So my understanding is that this does not include the demands for it, so it should really just cover the take-up. And we have this data for, in some figures, we have data until 2025, where we show how the system evolved. But for the cross-country comparison, we mostly have stuff until 2022, 2023. I hope this helps.
Michiel, do you still want to add something on these thoughts?
Yes, I'd like to mainly agree that after the COVID crisis, there were other types of crises that appeared and that have started mingling a bit with some of the results in a way. I don't know to which extent this, I don't think this really adds something or detracts something from the OECD study as such, personally, but it is an interesting subject to look at the working group Social Impact COVID-19, of which Anne and Tom, for instance, are also members. We changed the name, we changed the C to crisis, from COVID to crises during this period because we were no longer monitoring one crisis, but we were suddenly monitoring a lot of them. And I'd like to make a bit of promotion for one of our other studies that we've published at the end of 2024, which is a look at the evolution of temporary employment after the COVID-19 crisis. This was published at a time when the situation of the Belgian industry was just about turning again towards crisis perspectives, but there we treat the energy crisis, we treat the floods, but also some other properties of temporary employment during this time frame. And one of the things we saw was that in general levels seem to normalize and certain sectors seem to normalize. On the other hand, we were seeing larger concentrations. So while a lot of people were seeing, okay, general levels of temporary unemployment remain higher than before the crisis, what we were seeing was that, okay, this is true, but there's more going on there because we're speaking of normalization, but with higher concentration with some of the specific employers. So the structural usage that we discussed seemed to become a bit higher in a way, or at least the concentrations seem to become higher. We haven't studied this time frame, so I'm not sure if it's structural usage or not. In any case, this is a different situation than what we had before, and it's not a one-on-one crisis response. Some of the effects that we were seeing that are intermingling with this is, for instance, the growth of force majeure temporary employment because of cyber attacks. So this is this might be interpreted on a geopolitical level, that some of these attacks are geopolitical in nature, but it might just be that during the COVID-19, some people used the time to specialize in cybercrime, for instance. I'm not at a good place to make statements about that, but this is one of the effects that we're seeing. So after this COVID-19 peak, we are in a bit of a different situation, a bit of different reality in terms of temporary employment than before in many different levels. And it's a bit tricky to make general assumptions based on levels, etc. I think we I think we just need a bit more time in order to take a look at what is going on since then. We've published provisional results at the end of last year, but there are some evolutions and aspects that I think will be of very much interest to researchers in, well, maybe 2 or 3 years to shed some more light on what was added now.
Thank you, Michiel. And so there's a final question that I can actually answer myself, because it's about how to find the report by the OECD, and it has actually been published today on the OECD website, and I have put the link in the chat as well, so you can find it if you go to the meeting chat. You can find both the OECD report and the study by the National Employment Office. So that concludes our Q&A, perfectly in time for the conclusions to today. And for those, I will give the floor to Tom Bevers from the Ministry of Employment.
Thank you, Anne. Indeed, let me try to conclude this webinar. So what have we learned? Well, let me try to start with a bit the headline. It's clear that during the COVID crisis, our temporary unemployment system did exactly what it was designed to do, act as a powerful shock absorber. We saw that almost 1 in 3 salaried workers were supported by the scheme. 13% almost of additional job losses were avoided. This is, of course, very important. This success in an emergency, however, came with a second chapter. It was very good, first of all, that we had a system that we could scale up. As you may remember, from the onset of the crisis, the European Union decided to support schemes like ours with what was called the SURE system. And so there was a clear incentive for countries to create such a system, even for those who did not have it. And some of the countries that in Jonas's graphs had to go from a 0 to 100 coverage, like almost overnight, well, they really struggled with this. So it showed very good. It showed to be very useful that we had a system that we could scale up. However, it's clear that we kept the crisis provisions longer than most other countries, and our existing system looks also quite successful, even until now. If you compare it to other countries, take-up remains around 3%, while in most OECD countries, this is around 1%. It's always good to be cautious when you're an outlier. So logically, this raises questions that we also see in the Belgian policy debate sometimes about the persistence and the risk that the system becomes a structural adjustment instrument. Which is not what it's aimed to be. However, before we jump to conclusions, then the data that Michiel showed from ONEM RVA clearly urges some nuance. If you look at the micro level, you see that this structural or near continuous use that we often think about is concentrated in a small minority of firms, and most employers use the tool intermittently, tied to some short identifiable demand or supply shocks. And then when we look at these high intensity users, they also come in different types, but we often find lower skilled or very specialized workers with probably relatively weak re-employment prospects. So this is the group for whom we could fear that, okay, there is a risk of long-term unemployment if they would lose their jobs. While on the one hand, we could think about rigidity, on the other hand, there seems to be a role in protecting human capital. And that is where we need to find the balance. The OECD with a longer view lens, well, okay, but prolonged use, this can dampen productivity enhancing reallocation. We've seen some data that seem to suggest that this is a clear risk in the Belgian system. On the other hand, okay, there is a legitimate reason to protect some jobs, so we need to think about to have to move towards a system where, yes, we dampen shocks, we help people through temporary turbulence, but we don't hamper mobility on our labor market because, as we know from many other studies, okay, mobility on our labor market is quite low, and this is an issue. This dampens our employment rate. This also dampens productivity growth in our country. So what could this mean for policy? First of all, I think that the most important lesson is that it's, for once, very nice to have two high-quality studies on a labor market policy measure. This doesn't happen. Doesn't happen very often, and this is really something we should take away from today. It's very good to make policy with evidence, not just with anecdotes. There's a clear reference to the need for evidence-based policies in the current government agreement. Of course, this should be more than a wish on paper, so we should continue working on these type of studies. Then more specifically, what we could try to learn, well, we had a very good on switch for the system. We could scale it up overnight, and that is something we should keep. Of course, we need a system that has a rapid, a broad reach when there is an acute crisis. This was very decisive in 2020. On the other hand, we should not exaggerate. We shouldn't use the switch every time we think that something may look like a crisis. There are structural evolutions of the labor market that are happening anyway, and this is not the system to cope with them. And then, well, yeah, we have a country that is not good in phasing out temporary schemes. There are some examples of things that exist for decades and were meant to be temporary. So the off switch is a challenge in our country. So we could think about clearer exit rules for crisis, so that once we switch it on, we already know under what conditions we are gonna switch it off. That is the crisis use. Then we have the more structural system, and there I think what Michiel's data clearly point to a kind of differentiation. You really have different types of users, and probably our policy levers, eligibility, intensity thresholds, audit triggers. Maybe they should also try to differentiate between this intermittent shock-driven users, or on the one hand, and then the long-term high-intensity users, so that we avoid some restrictions that penalize legitimate buffering, but also make sure that the system remains viable. Structural use of the system clearly can save employment with a high social value, and this is where I think we should have the debate, because there the question could be asked, of course this is important, but is it the right way to support this kind of jobs? Is this a part of a normal level playing field between enterprises, or should we think about the financial incentives? Should we look at how it works? And then, yeah, the financial incentives. First of all, that's a complicated story. There was a reference to what collective agreements provide. We also, in the context of the working group on social impact of COVID, try to have a look at it in the first stages of the COVID crisis. It's a very complicated story. With indeed some strange effects, as was pointed out. Is is this how it should be? Shouldn't we make sure that the system is clear and transparent for all workers and for all employers? And maybe it's worth looking at some of the examples that the OECD pointed out, to look at what experience rating can do, to look at how we could shape employer co-financing in the most optimal way to encourage a responsible use of the system. Often when we talk about Belgian systems, we say, well, they should be simplified. In this case, apart from the financial incentives that I just said, the clear oddity is that we still have a system that distinguishes between blue and white collar workers. This should probably have been a thing from the past by now. So it's not, on the other hand, it's probably not the most urgent thing to tackle, but one day if we would reform the system, this is probably something we should do away with either. And then, yeah, the difficult question on training. Should the time that people are in temporary unemployment be used to train them? The answer is probably yes. However, given the institutional setup of our country, this is very, very complicated. Probably also not the main priority, but it's something we should think about. We know that we don't do enough lifelong learning in our country. We know that we don't invest in workers' employability enough, especially while they still have a job. So we should probably see temporary unemployment as an opportunity to train workers. How to shape this? Again, it's not an easy one. So to sum up, we need to reconcile two truths. One is temporary unemployment definitely works. It saves jobs, it saves firms when needed. The second is, yes, but we can slow reallocation. It can be a costly system. So we need to think about better ways to switch gear and also to get the targets, the targeting and the incentives right. So with that, let me close by thanking, first of all, the OECD colleagues, Jonas and Alex in particular. Thanks for the depth and the clarity of your analysis. Thanks also for the international cooperation. This is a huge added value, of course, that your work allows us to put Belgium in perspective. Thanks also to Michiel and his colleagues. This micro-level look is very important, and it reminds us also that policy lives in patterns and not in averages. A small share of firms can drive a large share of volume. So this, I think, is a big added value from the work that you have done and makes the two studies very, very complementary. Thanks to Anne and other colleagues from my ministry for the follow-up of the work, for the help together with Michiel with the data availability as well, which sometimes can be a challenge, and also for the organization of this webinar. And then thanks to all of you for being with us virtually today, administration, social partners, academia, and so on. And thanks for your questions and your interest. And as Anne has said, you can find the two reports on the respective websites. So with that, let me close this webinar and wish you all a nice working week. And for those who are about to have lunch, a nice meal.